We continue with our discussion on Unit 3 in Advanced Financial Modeling, and we're now going to talk about the projection of data on the balance sheet. We've already seen the revenues, costs, and other income statement items. Now we're going to look at the projection of balance sheet items. Right. So when we look at the projection of balance sheet items, typically the balance sheet would have the structure of liabilities on the top, followed by assets on the bottom. Now, within liabilities, there is equity, which is not really too difficult to project because we usually assume that unless there is evidence for us, the company's equity would remain same plus the profits of each year, right? So when profits are made and not redistributed, they go and get added to equities, right? The debt projection is what we have to do, and primarily long-term debt. And then you have current portion of liabilities that come in. On the asset side, you have to first project the non-current assets and understand what drives those non-current assets. And then you have to look at the current assets primarily. So our focus would be on the long-term debt bit, non-current assets, and current assets and current liabilities bit, which will basically mean that the three major items would be loans, capex, and working capital, because that's current assets minus current liabilities. These are the three major items that we have to look at whenever we are projecting something in the form of a company's balance sheet, right? Those are the primarily relevant ones. Now, so let's first start with the understanding on forecasting of balance sheets with respect to projecting the non-current assets or forecasting non-current assets or the drivers for non-current assets, right? So we need to find out how much is the fixed asset, tangible plus intangible, for a company based on its capacity. Remember, if Maruti makes cars, then what is it? What is the gross value of fixed assets or long-term assets for a certain capacity? Remember, your fixed asset or your long-term assets are going to be a function of your capacity. There is no real difference between these two. If you add capacity, you expect the fixed assets number to go up as well. You will not have a scenario where capacity can go up without fixed assets going up. So in some form or fashion, these two need to get related. Now, where do we get the capacity data? This is available on the annual report. Where do we get the fixed asset data? This is again available on the annual report. If we look at the annual report, this data would be available, right? So this will give us an approximate number of capital expenditure needed to increase capacity on a per car basis, right? Capacity on a per car basis. That's what we are worried about. So let's look at this data for our company under example, which is Maruti. So that's the balance sheet we are looking at, and we are basically looking at a few data items in terms of the shareholder funds. Remember, reserves and surplus, we just add the profits of that year. The long-term borrowings is one area, but we're now looking at specifically the non-current assets data. Now, when we look at the non-current assets data, you will note that there is one more sheet that gets added here. That's called the capex schedule. We just added a new sheet so that we can do calculations related to the non-current assets here, right? Now, what are these non-current assets? Total value of gross long-term assets for Maruti is available on this sheet. So essentially we are looking at what is the gross long-term assets or non-current assets, gross value, then total accumulated depreciation, and the difference of these two should give us the net value of long-term assets. So we can just find the difference between A minus B, and that's the net carrying value. On the balance sheet, we typically carry this value. Now we can basically try and find out the capacity. Remember, the capacity data is available here, and you would need these fixed assets primarily for the capacity, right? So I can go and put the capacity numbers here, and we can link it from FY11 onwards. And maybe there is a little bit of a discussion that we can have in terms of when does the capex happen, how much time does it take, because you note that the gross assets start increasing here over this period, but the capacity only increases here because capacity only comes on stream once you find the production starting, right? But we can find gross long-term assets per car, and we can just multiply the total gross value into 10 raised to 7 to convert it to crores and divide it by the number of cars to be able to find out how much would they need as capex per car. So effectively, if we look at the gross long-term assets per car, that's gone up to somewhere around 1.5 lakh from 93,000. So if they want to add capacity, how much the company needs to add in terms of the numbers is what is available from here. So let's say tomorrow the company wants to increase capacity by another 10,000 cars, and this becomes this plus 10,000. Then we know for these additional 10,000, if the company needs exactly 1.5 lakh rupees, then your capex or capital expenditure could be basically the new capacity added, which is 15 lakh 20,000 minus 15 lakh 10,000 multiplied by the 1.5 lakh per car number that we calculated divided by 10 raised to 7. So for these 10,000 cars, the company will need 150 crores, right? If this number was, let's say 1 lakh, instead of 10,000, we are saying 1 lakh, then you would need 1500 crores of capex that the company would require to kind of put aside, right? So this is basically how we try and find out what is the fixed asset value and typically link the fixed asset value to the capacity of the company, right? So I'll repeat what we've just done. We have taken the company's gross long-term assets, which is available on the annual report. We have taken the company's capacity, which is either available in the annual report or it is available in terms of news items or on the website of the company. And we try and find out gross long-term assets per car capacity. Remember, this is not based on sales. My assets will depend on what is the size of the factory I have, which is what is the capacity that I have. Assets will not depend on what is the sales value or volume of the company, right? I may not be using half of my capacity. So effectively what we identify is that on a per car basis, when they were producing 12 lakh 60,000 cars, their total assets were 11,000 crore. When they're producing 15 lakh cars, their total assets are 22,000 crore. So basically, they have seen an increase in the gross long-term assets per car capacity. Maybe that's because of newer technology or whatever, this number has gone up. But for every car extra that they make, if they want to add capacity by one car, they have to increase capex by 1.5 lakh rupees. This, remember, is in rupees. And then we can find out, we just tried and did a simple calculation where we said if the capacity goes up by a lakh, because for every car they need 1,50,000, for a lakh new cars capacity, they will need 1,500 crore of capex, right? That's the non-current assets bit. We can try and understand the key drivers. The key drivers would in this case be capacity. If I was doing the same for a services firm, like let's say Infosys needs gross long-term assets on a per employee basis. They are basically looking at how many employees can sit in their facility. For every employee, they need a computer, they need a furniture piece, etc. So all their long-term assets are going to be driven by employees. Their driver is employees. The driver for Maruti is capacity of cars that can be built. It is therefore important to understand what are these drivers. Next, we move on to non-current liabilities. Now, primarily this depends on the long-term borrowings of the company, which is long-term debt for greater than 1 year. We can find this out or we can project this based on the company's capital structure. Usually, what would you need long-term debt for? This would be for capacity expansion. There is no other reason why you will need long-term debt. If you need money for day-to-day operations like working capital, you will need short-term debt there, right? So capacity expansion, you can project this based on the firm's capital structure. For example, if the firm maintains a debt equity of 1:2, then for a capex of rupees 300 crore, you have to divide into debt and equity. And because you are maintaining 1:2, you will take 200 crore of equity or internal accruals or profits of the company and 100 crore of debt. So they are likely to raise 100 crore of debt. So this will have to be built in and explicitly specified. These assumptions will have to be built in and specified so that everyone is clear how much debt the company will raise, right? In our Maruti example, the company doesn't have too much long-term borrowing. So there we can't really predict it. But let's say if we were to predict it, then and we were to say that capex was going to happen, then we can make a projection of capex based on debt, and that would be this into, let's say, 33%. So roughly about 500 crore or close to that kind of debt would be needed to be raised to fund this capex, right? And I can write here somewhere here uh, with the debt assumptions itself, we can either add a comment and say assuming 1:2 debt by equity. Now, in this particular case, we are not, we are sure that Maruti doesn't have too much debt. If you look at the balance sheet, on the balance sheet numbers, you will find that the debt number is only about 145 crore, whereas the equity number or shareholder funds are quite large. Right, so here it doesn't matter, but in most other companies, this is the mechanism that you're likely to kind of deploy. You understand what is the debt equity of the firm, and you try and find out if they maintain it. You can do that by simple ratio calculations, and then you just assume that further capex is going to happen at this kind of a rate. That's the standard judgment you start with, right? Finally, once you have done the non-current portion of assets and liabilities, you move ahead with the current portion of assets and liabilities. Now, this is basically working capital, correct? So when you look at current assets and current liabilities, and current assets, you can uh, leave out cash. So you're looking at X cash current assets, which is only the non-cash current assets is what we are trying to project, right? Usually, companies try to keep working capital as a percentage of sales constant. We've already read about working capital, and we say that companies try to keep working capital stable as a percentage of sales. So we are saying working capital by sales is stable, which is equal to current assets minus current liabilities by sales, which means current assets by sales minus current liability by sales. The company tries to keep it stable. So we need to find out current assets divided by sales or current liabilities divided by sales. We can find it out in terms of percentage of sales. Remember, if I divide it by this number, so let's say I take receivables and I find receivables as a percentage of sales. I can also just divide it by 365 here. So sales by 365. What that means is how much is receivables in terms of per day sales. If you remember, this is our notation that we saw on a per day basis. The same equation can be written as 365 divided by receivable turnover ratio, sales by receivables, right? So effectively, we have taken the receivables turnover ratio, divide 365 by that, that gives you the days sales outstanding. We have seen this in our working capital discussions in AFSA, right? So we can also find this, that's effectively the same as trying to find out what is the working capital data as a percentage of sales. So let's go to our Excel file and try and identify this. On the assumptions part of the sheet, we have just plugged in the numbers for working capital drivers and we have put in short-term borrowings. I can link all this to my balance sheet. So on my balance sheet, these are my short-term borrowings, and I can drag it down and I can drag it on the right side. So we get these numbers available with us. And then inventories are also on the balance sheet. That's on the current asset side. Remember, we are leaving out two line items here. I'll tell you which two one in a minute. So trade receivables, and I'm going to go to my balance sheet and put short-term loans and advances that the company has given out to someone, and these other current assets. We can add this up and put it here. Now, when you look at the balance sheet, we have left out two line items. What are those two line items? We have left out cash and bank balances because that is going to come finally from the company's work, and that's going to be the balancing number. And we have left out current investments because this current investment is nothing but investments made out of cash and bank balances. So current investments and cash and bank balances are effectively cash equivalents for us, right? We remove those portions out. So now we can find out working capital as percentage of sales. So I can take all these numbers and I can find out working capital as percentage of sales, right? So we can write as percentage of sales because company tries to kind of keep all these data points constant. And how do I do that? I can just take each of these numbers and divide it by the sales number for that year. Do we have the sales number? We have the sales number here, revenue from operations, right? And I need to freeze the row but not the column. So we do this, we format it. So in terms of formatting, this becomes a very small number, short-term borrowings. We drag it here, we drag it down. And we find in terms of percentage of sales, the numbers are available. Now, do we identify some trends? So if you look at payables, payables are typically about 10% of sales for the company. If you look at inventories, inventories hover between 3.5 to 5% of sales. Receivables are close to about 2% of sales. Now, these numbers can subsequently be projected in terms of trying to find out what is working capital as a percentage of sales. If we identify that the company has maintained certain numbers at certain levels, then it's simple to project those in the future. We can also convert working capital in terms of days worth of sales, right? So I can take all these numbers and note that if I basically just multiply each of these with 365, right? So in terms of days worth of sales is what I'm looking at, right? If I just do this and I just take these numbers and multiply by 365, this into 365, right? So that's the days worth of sales that we are getting for all the line items, correct? And that tells us that the company maintains an inventory of close to about 12 to 15, 17 days worth of sales. The company maintains receivables of close to about 7 to 10 days of sales, right? The company pays money after about 37 days of the cycle. This is exactly what we mean by the cash conversion cycle calculations that we have seen in AFS, right? So under working capital assumptions or current assets and current liabilities, we are either trying to look at it as a percentage of sales or take it, divide by sales by 365, which becomes receivable divided by sales into 365, because this 365 will go up, right? That's the calculation of forecasting of balance sheet items. This will become clearer as we try and do this for a lot of companies, but that's the primary way of how do we forecast the major balance sheet items, right? As we end this particular session, what is the way, how can we project debt for any company and explain how can we understand the working capital drivers of a firm? Thank you.